Welcome to TMS Insights. February is reporting season, which means it's busy at TMS, and this is the first of two for the February reporting season that we'll bring you to update you on the company reports. But maybe to begin, Ben, we should talk about what's been the bigger moves in the markets. Two things really. One is obviously an interest rate environment, which is concerning markets, and also the macro events, the global events around Ukraine.
Yeah. One, I think, not really that something that might get the market's attention for a few days. If something really does kick off in the Ukraine, we've seen 9 times out of 10, they're kind of buying opportunities when you get those things. It could have some impact on oil prices and stuff like that. But inflation and interest rates is a lot more meaningful to every asset market, not just shares. And we have seen a very swift change in the outlook for rates from the Fed, from the ECB, from the Bank of Japan, from every central bank around the world, who has all been trying to work out how permanent this COVID-induced inflation will be. And clearly, as we hit December, there was a real shift in their view that they couldn't afford to be behind the curve if inflation did turn out to be more permanent and longer lasting in nature. And with that has come a complete shift in bond yields, and that has flowed out into asset prices around the world, although there is signs it's calming now, I guess, as we speak.
Yeah, it's a material adjustment. It's one that we definitely take note of, and I think you positioned it well that the Ukraine style of thing is a global macro thing that comes and goes a little bit, and we're more interested in the opportunities created by that. The interest rate environment changing is natural, normal, but it's material, and it changes who will be the leaders in the market and who are the ones that will get a bit of an uppercut. And,
which we've seen.
Which we've seen. And it's been a rotation out of growth into value, and it's been a rotation out of bonds as well.
Yeah.
And you see that. So where is the right place to go? Well, one of them is in high quality, shorter duration equities.
Yeah.
And they're businesses we talk about all the time on these calls. And it also means high quality growth companies whose earnings can grow faster than the inflation rate.
Yeah.
And that overcomes the change in the PE crunch,
Absolutely. There's the saying, I think, in the markets at the moment, you want to find businesses that can outgrow the Fed, i.e. the earnings can grow faster than potentially the PEs can contract. And without getting too technical, it does get... But I think, if you look at the US bond market, it is now priced in 6 to 7 interest rate rises this year and several next year. It sounds like a lot, but you got to remember we're at 0 and we're talking about rates maybe getting up to high 1s, which is still very low versus what we've historically seen. It's just that the speed and the timing has completely changed from where we were at in December, and that has created a real knock-on effect into asset markets. But I think the market is now quickly moving. It's priced that in. We all know that's now going to happen. It's where does the rate rising cycle top out, and which is called the terminal interest rate. Is it at 2%, 2.5%, 1.5%? And I think bond yields to me have probably priced in a more aggressive scenario, and a lot of it's going to come down to what COVID does next as well, of course.
Yeah, that's right. And what it takes us back to is stocks. And what we've seen is the companies reporting on their December half year, which had some of these impacts of inflation.
A lot of lockdowns.
Lockdowns. So a lot of these things are coming through. But amazing, Ben, how a number of companies have demonstrated really good numbers already. So even though their share prices come down because we may have seen the rotation out of growth, they're growing their earnings, which is the best way forward, and whatever the short-term price noise, they're going to overcome it. And let's jump into one of those. One we always tell viewers we find is one of the premium stocks in that part of the market, REA Group, another cracking result.
Yeah, incredible. I mean, when you think you got to think back to what the last 6 months looked like. And, it's like 3 months of it, the country was the East Coast was in lockdown. And REA grew its earnings 37% during that period. It's going to have a ripping quarter this quarter we're in now, and probably a slower quarter in the fourth quarter because of the the Easter school holidays and the election that we've got during then. People reluctant to sell during those periods. But this is a business that actually should do well out of a rising interest rate environment. The valuation might not be so good in the short term, but in the medium term, rising interest rates will mean a more levelled out housing market, which should come into balance, which should mean more volumes coming onto the platform, which is what REA needs to make sort of growing earnings.
Because those red hot property markets aren't their best friend. That's the bottom line.
It's actually bad for
don't get the listings.
REA.
Yeah.
A lot of stock is sold off platform. So it was a flawless result, a very bullish outlook. And, you can scratch your head and think, well, why has it dropped $20 a share? It's purely because of the macro move in bond markets. Yep. But these are the businesses that will bounce first and hardest as, we do go into a recalibration or, as things recover.
Yeah.
That's what you want to think about from this point. You want to be in the businesses that are performing really well. The money will come back to them first when that part of the market starts to run again.
CSL reported this morning, it's been obviously on the acquisition front, so capital raising front. Share price has been under pressure from reasons we described as well, but the result was really appreciated.
Yeah, hit guidance. I think the surprise was the lift in the outlook for the full year, and that's been really generated by the US, which is their main country they collect blood and plasma from. Is coming ripping out of Omicron. And, when you speak to people who travel to US at the moment, they're just like, COVID isn't even discussed or an issue over there. So that has actually, it looks like it's sped up recovery volumes and collection volumes. And that has seen the company upgrade its full-year earnings guidance, not by a lot, by about 5% this morning.
But a bit of good news when the share price come back a fair way, really. So that's certainly good to see. Car sales, another good result from there. And also Seek, it was an upgrade from Seek, wasn't it?
Seek had probably the biggest profit upgrade I've seen since we've owned the stock, and probably one of the biggest we'll see in this earnings season.
Think so, yeah.
20 to 25% upgrade versus their November guidance.
Yeah.
And it's really down to how tight the employment market is at the moment. A lot of people are looking around, we all know that. Employers are fighting hard to try and attract staff, and the big thing for Seek was they've rolled out this dynamic pricing model, which we're still sort of getting our heads around, I think. But it looks at, more like an REA style pricing. Yeah.
Where you've got levels and your thresholds, and so it's going to add to the bottom line without any extra cost.
Pricing of the ad more aligned to what the salary of that person is going to be, just as REA does with the value of your house.
Yeah, and what headhunters do too, so it makes sense. And the car sales one, again, they've done particularly well. I mean, it's been an unusual period again. Last year was unusual, but it's continued, and they seem to progress in either environment. Yeah,
because there's just been a lot of additional trading activity in the second-hand car market because new car manufacturers can't get stock because of all the chip shortages and all of these sort of issues with COVID, and therefore there's been a lot more turnover in the second-hand where car sales just completely dominate.
Yeah.
And they've been putting up their prices during their time, so been a pretty good period for them, that's for sure.
A really good period there. The Resmed result, I mean, they had a 2021 like they couldn't have dreamt of, really.
No,
I mean, you're in an oligopoly market, and a key competitor has massive fault issues, and you win their business short term, but probably long term as well.
Yeah, and the only issue facing this company, another little one I listened to, Ordinate, similar, is just securing the supply chain. Resmed, their biggest problem at the moment is they literally cannot meet demand. They've got their own customers who are wanting to upgrade to their latest device, but then they've got all the Respironics customers who can't get a Philips device because they're being recalled, trying to come across. And the issue for them is flexing the supply chain and to trying to meet the demand. And that really, it's for Resmed, it's not going to be growing. It's just going to come down to how much they grow.
Yeah.
And that will be due to how well they manage the supply chain.
Interest rates knock a lot of growth stocks around, but they help other companies. The banks and commodity stocks benefit.
Yeah.
Combank report, really good.
Yep.
BHP, surprised, very high expectations too.
And delivered on them.
Yeah,
and
absolutely.
you know, monster dividends, balance sheets in great shape, not making the mistakes of the past where they're not rushing out and buying things in, you know, I don't know where we're at in the cycle, but it's strong.
Yeah, well, they're great times. So, and typically that causes errors at the acquisition level. So,
and I think there's a great article in the Fin today, Mike Henry talking about not making those same mistakes that have been made in past high cycles. So
they weren't his mistakes, but they were BHP's.
He was there when they were made.
And he's seen it, and that won't happen.
Yeah.
Got a very clear focus.
Yep.
So, and that's good tailwinds to the business, really.
Yep.
That's the other side of things. So they've done well. Ben, I suppose just summing it up, so that's how it looks for the early part of the reporting season. What's coming up will probably be a bit more mixed, I imagine.
Yep.
And we're looking for how labour costs and input costs rise, because that'll tell the story of the current period and what's coming up.
Yeah, it will come. Last half was such a weird 6 month period. I think everyone in the market is trying to work out what a normalised earnings look like for a lot of businesses.
Yeah.
Because costs are all over the place, supply chains are in chaos, and you've got these weird revenue
and
patterns.
Different streams for different businesses, right?
So, yeah. So it's it's messy at the moment. There's quite a lot of volatility. A lot of it is just due to this unusual environment we've been in and hopefully are coming out of. But I've got to say, like, just to end what we're talking about, I think every single company we own for clients has positively surprised.
Yeah.
And at a minimum, it's been, you know, in line with expectations. So knock on wood that keeps going. But it's been good generally. And, you know, I think you've got to phase out the big macro forces that are going on, concentrate on the businesses you own, and as long as they're delivering, you're comfortable and you stick with them.
Yeah, and you can be comfortable about where they're going beyond all of this noise at the moment. But we'll bring you another update later in February.